Imagine you want to buy a new car priced at $20,000. You start saving monthly, and after a year, you manage to save the full amount. But when you go to buy it, you find the price has increased to $21,000. This is what we call inflation. Inflation constantly eats away at the value of money over time. It happens in most countries, although the rate varies depending on each country's internal and external conditions. That's why you should not keep your wealth in cash. Now, focus on what I'm about to tell you. It could improve your financial situation. What does it mean to convert cash? It means transforming your cash into assets and investments. As we mentioned, this helps preserve its value and grow your wealth. However, do not forget to keep enough cash to cover personal expenses for 6 months, along with setting aside a monthly amount in an emergency fund. Personal expenses include food, utility bills, rent, and transportation. What remains of your money becomes savings, and that's what we'll talk about in this episode. We will discuss one of the most important concepts in investing and money management and the factors that influence our investment decisions. Today's topic is the financial portfolio. Most important concepts in investing and money management and the factors that influence our investment decisions. What does financial portfolio mean? How do we build one? What are its types? How do we diversify investments within it? What are investment goals, time horizons, and how do you determine your risk tolerance? Let's get started and check on our money. Many people have a financial portfolio without realizing it. That's why many of us live with random or unstructured financial planning, which prevents us from achieving our financial goals. As you've noticed, I mentioned assets and investments. What's the difference? All investments are assets, but not all assets are investments. If an asset generates income or increases in value, it is considered an investment. For example, a car used for personal use is not an investment. But if it's used for rental purposes, it is an investment and part of your investment portfolio. Likewise, a house you live in is not an investment, but if you rent it out or keep it vacant for value appreciation, it becomes an investment. So a financial portfolio consists of assets you own that generate income or increase in value over time, or both. For example, a rented property provides income and appreciates in value simultaneously. A financial portfolio is a collection of financial assets and investments owned by the investor, such as stocks, bonds, real estate, cash, or even alternative investments like gold or cryptocurrencies. The purpose of creating a financial portfolio is to diversify investments, to reduce risk, and increase the potential for returns in the short or long term. Now, do you want to build a financial portfolio? Will you manage it yourself or let a specialist handle it? What does portfolio management mean? A financial portfolio includes several asset types like gold, real estate, stocks, and bonds. To manage it means adjusting your investment allocation in each asset based on your financial goals and considering your risk tolerance. How do we build a financial portfolio? First, you must assess your financial situation. What assets do you currently own? What are your income streams? What is the size of your investments, debts, savings, and monthly expenses? This will help you build an investment strategy that suits your profile. To determine what kinds of assets and investments to include in your portfolio, consider the following. Investment goals. Before building your financial portfolio, you need to understand why you're investing. Is your goal saving for retirement, buying a house, earning extra income, in stocks or mutual funds? 3. Risk tolerance. Everyone has a different level of comfort with risk. Some prefer safety, while others are willing to take risks for higher returns. Knowing your risk tolerance helps you choose appropriate investments. There's a direct relationship between risk and return. The higher the risk, the higher the potential return. This depends on your ability to handle pressure and the chances of profit or loss. Example: a conservative investor focuses on government bonds and fixed deposits. A moderate investor splits funds between stocks and bonds. An aggressive investor focuses on high-growth stocks or cryptocurrencies. Practical example: let's say you have $100,000 and want to build a balanced portfolio for retirement in 15 years, accepting moderate risk. Your portfolio might look like 50% local and international stocks, 30% bonds or sukuk, 10% gold or alternative investments, 10% cash for emergencies. How to manage your portfolio? Monitor portfolio performance regularly. Rebalance assets when necessary. For example, if stocks rise significantly, you might sell some to buy other assets. Stay updated on economic news and how it impacts markets. In summary, successful portfolio management relies on clear goals, understanding your investment timeline, knowing your risk tolerance, and don't forget, diversification is your smart weapon to reduce losses and increase opportunities. If you liked this video, don't forget to like and subscribe for more financial content.